I see Owen. Is it with a from top? He's on the Star Trek. I can see him there.
Yeah, I try and.
So we come to this. So the last talk of the day. This is actually the experience of the British Isles has actually had of secession. So which has been a theme throughout the day. So it'll be interesting to hear some reflections on that. So this is Owen McLaughlin at UCC and Sean Kenny at Lund University on the political economy of secession, lessons from the early years of the Irish Free State. Over to you, Owen.
Cool. You can hear me okay? Yeah.
Yeah, no problem.
Grand. So I put these slides together. It's based on work that I've done independently and Sean, and we're kind of pulling what we've done together. And I thought like the earlier papers I can link into, especially like the first one from Alan McDonald, cover a lot of the stuff, and then I realized actually that I'm covering some regional stuff as well. So hopefully it links in and you can see where the parallels are in the analogies. So when Ireland secedes, it secedes from a political union, an economic union. It's a fiscal and monetary union as well, but they choose to remain in the monetary union, and that's an important point in all of this. So I think like the lessons from the Irish experience are applicable to Scotland, Wales, Northern Ireland, and you know you can take what you want from it. And I also like this picture here, so I was looking for a nice picture. What I'm going to focus on isn't how they got secession, but how they implemented like the new machinery. So this is when they get the keys of Dublin Castle. This is Michael Collins walking out after he gets the keys from the Lord Lieutenant. So yeah, Ireland taking over from England this session. I'm taking the keys of the castle. Comparative growth performance. So this relates to what Alex was talking about earlier. So Alex is talking about, you have this persistence. So if I did this talk in the 80s or if I did this in the 70s, Ireland would look like it made a bad decision, because that's what like the second slide here. It looks like it would have very low growth, very low levels of GDP per capita. But if we did this right up to the present day, Ireland's actually it's a high performing economy. What I've done here, so most countries are GDP, but Ireland is GNP. I've tried to adjust for leprechaun economics basically. So for Ireland, for the early period, GDP is actually less than gross national product, and for the later periods, GDP is much greater than gross national product. So there's a lot of distortion, so I focus on GNP. But what you see is this distinction. And I've tried to highlight the regions as well. So I put Wales, Northern Ireland, Scotland in both figures. So for the the long run period, Ireland, the Republic of Ireland does better than the regions in terms of growth performance. But in the the period I'm going to look at, Ireland does comparable to the regions. So the counterfactual, what would have happened if it stayed in the union? It probably would have done worse than it had done leaving. So that's kind of what I want to get into. So just some regional context for this. So really, like this all kicks off 1918 election. There's a traditional division between nationalists and unionists, but the 1918 election changes everything. So there's a new nationalist party, Sinn Féin comes in. The old nationalist party, they have barely any seats left. I think they get 4 or 5. So they're completely wiped out. Sinn Féin come in, they're a brand new party. And the previous nationalists wanted like devolved government. It was legislation passed 1914, delayed because of the war, but situation changed radically after that. The other kind of interesting parallel is that this is during a pandemic, so parallels to today. This is the 1918 influenza pandemic. Also relevant parallels. So if you're setting a new state, this is severe economic dislocation. It's following the First World War. It covers the Great Depression. World War II is here as well. So there's a lot of things that are relevant for today. So I would encourage people to pay attention to it and not discount it. So I was going to put in a picture of kind of the recent Sinn Féin leader, so Mary Lou McDonald in the South. So this is Arthur Griffith and the Sinn Féin policy. So he wrote this in 1904. 1905, he has like a conference about Sinn Féin. One of the main things is like he doesn't want Irish MPs to go to Westminster. He wants them to get elected and stay in Ireland. That's what they do in 1918. But his other thing is he wants protectionism. So he wants to create like tariff barriers, protection, infant industry argument. And he also advocates for bank runs because he wants people to hoard gold in Ireland. So go to your bank, demand your gold rather than accept paper currency. So he's making all these radical claims, but he's not in government when he's making these things. And that's an important point. So Sinn Féin makes a lot of these radical statements, but when they come to, or there's what is left of Sinn Féin, when they're in power, they don't implement any of this stuff. UK regional GDP in context. So this is 1900s, 1925, 1938. Ireland, north and south, are consistently the poorest regions in the British Isles. So I heard earlier that Wales is doing better than Ireland, according to these figures anyway. So this is relative to the UK as a whole. London stands out, obviously, but the south is comparatively worse than the north. And when there's partition, most of the heavy industry is in the north, if not all of it, and the south is primarily agricultural, which explains this pattern. And if you look at then kind of performance over time, this is regional performance. The south of Ireland does really poorly throughout. So it's usually one of the lowest performers on these figures. So what I want to focus on then is really like the fiscal foundations, kind of how the Free State differ from the UK, what was sovereign debt situation, what was the currency and credit situation. And the really nice thing is that we have a trade war, we have protectionism, we have kind of parallels with today going on. So the Irish Free State then, so what this does, it's an agreement, it's founded after the treaty between Great Britain and Ireland. So it's 1922 is when it really kicks off. And what it does is it gives a greater potential control over all aspects of economic policy. It's notably different to what devolution would have been. So that's what Northern Ireland gets and still has, because it has power over effectively just trade policy. So it has power over excise and customs. So Sinn Féin had called for protectionism, but what we see in the 1920s is there's no rush to protection. And in the 1930s there is protectionism, but it's kind of in the context of the time, it's what everyone else is doing. And then here's kind of like one of the interesting things. So Ireland, the Free State and the UK, they both share the same tax system before secession. Income tax was introduced in the UK, so Great Britain and Ireland, same time in 1853. But the Free State is dependent on customs. So even though it's a free trade area, effectively, it's still the customs are a higher share of revenue in the Free State than they are in the rest of the UK. So the Irish tax system then is very regressive compared to the UK. And what this means in practice is that the people that supported the kind of secession, or they're the ones that have to pay for it because they're paying the kind of customs duties. So it's argued that it's because of how the southern economy was structured, it's heavily agricultural, that this was the fiscal stance that was kind of forced on the people. And so it tended to favor the people that hadn't been supporters. So the high earners aren't paying a lot of tax, primarily because they don't want capital flight. They don't want to lose any taxpayers. So here's another example. This is kind of a constraint on what the Free State can do. They always have to keep income tax rates in line with the UK, and it always has to be below. So to start slightly higher, but then they lower it. And whenever the UK does something, they lower it. They have to respond almost immediately. And the fear is capital. Wage capital is very mobile this period. The fear is that they lose, any remaining direct taxpayers. When the Free State first founded, it's very difficult to enforce tax payments. There's a lot of evasion and avoidance. And they're also trying to encourage people to come back to the Free State who might have left because of the violence, and they want people to come back and they want to offer a lower tax environment. So you can see like where a lot of the stuff with Ireland today, where it tries to have a lower tax environment, is this kind of thing, trying to be competitive versus its nearest neighbor. Fiscal capacity is very limited then, so it's reliant on customs. It's effectively free trading. The implications of this then, so it inherits this Edwardian welfare state. It can't afford it. So there's a lot of welfare payments for pensions, for social welfare. They just can't afford it because they don't have the fiscal capacity of the UK. The UK had subsidised a lot, so that would have, parallels with what's going on with, say, Scotland, Northern Ireland, where the central UK is a lot of transfers. So the thing I have to do is make a tough decision to cut welfare payments. Government, these are kind of primary deficits. This is a figure from Fitzgerald and Kennedy, but it's always kind of been negative for most of the history, which is, it looks strange, but this is actually kind of what happened. So sovereign debt, that brings me onto. And so this is kind of the work where Sean comes into this. So Sean and John Fitzgerald has this paper about Sudeto's Park, and their motivation for looking at this is like, so where did the border actually come from? And so the border is kind of wasn't agreed. There was no agreed definition what the border would be, and there's a boundary commission. And the North, the expectation in the South was that Northern Ireland would be smaller than it is, but then the boundaries didn't reflect what they thought it would be, and a quid pro quo for accepting this was a debt write-off. So under Article 5 of the Anglo-Irish Treaty, the Irish Free State was to assume liability for a fixed share of existing UK debt. This was estimated to be 80% of Irish GDP, and they effectively got a write-off. And part of the reason for this was that, like, the Irish Free State government had to sell this as a win to the Irish people for kind of accepting the Northern Irish border as it was. And so this was one of the things for it. So the significance of this, Ireland, compared to the rest of Europe after the war, has one of the lowest debt servicing as a share of tax revenues, as a share of expenditure compared to other European countries. And this is one of the biggest debt write-offs in history. So Ireland, the Irish Free State, compared to other countries starting off, there's a lot of new countries formed after the First World War, but Ireland is one of the kind of in the strongest positions. And then this is the Economist writing. So I've given the Economist the green jersey here, because it's actually George O'Brien writing for the Economist. But it's very, heaps early praise on the Free State, that the Free State has restored order within its boundaries, and having completed its organisation as a government of an independent unit politically and economically, is in a position to close the list of applications for its first national loan. The first national loan is oversubscribed. So when they were trying to raise money, they thought they'd have to get a guarantee from Westminster to raise the money, but it's actually oversubscribed. And so this was a kind of seen as a vote of confidence in the Free State. And this was a point raised earlier. What would the yield be on Scottish debt? Well, this is kind of potentially counterfactual. So this is a country after experiencing civil war. It's after seceding from the Union, but the yield on Irish Free State debt is not that much higher than compared to the UK. And I'm actually being very generous to the UK here. So this is just consoles. The UK, majority of UK debt is actually war debt. And if you include that, the kind of the premium isn't that high. What I've highlighted here is the default, which I'll talk about in a moment or two. But that's when you start to see a kind of wedge coming in between Irish yields and UK yields. But this is only consoles. When you bring in the war debt, you're into a different scenario. What moves this? So a lot of political uncertainty seems to move it. So this is the work of Fitzgerald and Kennedy. They see kind of movements in the first national loan price being related to various government, major political episodes at the time. And then that brings me on to another thing which isn't included in that, and that is one of the major sources of debt for the Free State. This is land bonds. This is an earlier policy which the UK had issued bonds that financed the purchase of land and transferred ownership from landlords to their tenants. There's a massive kind of asset-backed security thing here. This is the only kind of debt that has, you could specifically link this to Ireland. The rest of the UK debt, it's a general imperial debt, but this is specifically for Ireland. It's guaranteed by the UK. So this is work that myself and Nathan Foley Fisher did. And we look at the spread of these land bonds. And we were expecting, because like when I was working on this, I was in Scotland, and I was expecting to see some kind of premium on this. But there wasn't that much of a premium. So if you can see here, compared to UK government bonds, this is a weighted average of all UK debt. Compared to this, there isn't that much of a premium, and it really only opens up. There's some like volatility, I guess, in the 20s, but when there's an Irish default, and once that default takes place, you see kind of a closure in the gap between the UK guaranteed bonds and then these Irish ones. And these land bonds, the issue of land bonds are way more than the national loans. Like there was a Land Act in 1923 that raised about, I think it was 23 million compared to the first national loan, which is 10 million. But the 1923 Land Act was guaranteed by the UK government, co-guarantee effectively. And the reason for this was the UK didn't want a failed state on its border. It didn't want, because there was still revolution in the countryside, it was civil war. And this was seen as a way to kind of end the grievances. The other thing then I'll move on to is currency and credit. So the economists, when they're doing the write-up, they noted that there was no hurry to establish a currency. And what I have here is the closest that they do to establishing a currency, which is nothing. It's symbolic. They issue a bunch of coins, and they get it. They have a competition for artists to design these coins, and the winner is like it's a bunch of animals, because the Free State is an agrarian society. So you have these animals. Apparently, the church didn't like it because it's very paganistic, but people didn't mind too much. That's the closest they get. This is the Irish punt, effectively, which is really it's a peg against sterling. So it's a peg against sterling. It's in from 1920 to 79. It's in three distinct phases. The first phase is just private currency. It's what had operated so that the banks, they're tied to their old way of issuing notes. It's backed by gold, effectively. Then there's a currency board. Then there's a central bank from 43 to 79. But is it really a central bank? So the argument here is that the de facto currency board, pretty much for most of the time, like it doesn't do much of the actions of a central bank we'd expect. It still plays the role of a currency board. So being generous, giving it to 65, probably to 79, still a currency board. And then 79 to 99, it's a float. And then it goes to euro. And one of the arguments for why it goes to euro is that people actually liked the stability of the peg, and people didn't like this floating currency. So that's kind of it. So what is the implications of the peg, and just some stuff here? The first figure, if you can see it, is just retail prices in the UK and Ireland, and they're almost perfectly correlated. Like, I don't need to do much. If you look at price differences, like so the change in retail price index in both, they're pretty much the same. So if there's any inflationary episodes in the UK, Ireland imports it. So it's tied to that. One of the implications of this is that the bank rate has to, the Bank of England bank rate was the blue line in the figure, and the Irish rate was the commercial bank rate, and then later the central bank rate. The Irish rate always tended to be above the UK rate. And the idea here as well, if the UK reduced rates, Ireland would follow, but not to the same level, and trying to attract capital to Ireland, and vice versa. If UK raised rates, Ireland would try and raise them too. The only time they didn't do this was twice in the entire history of Ireland, one in the 19th century and one in 1955. And when they didn't do it in 1955, it was a major macro shock. This thing here is just kind of messing a bit. It's like, did stability, so price stability, come at the expense of development, and looking at growth rates in different periods. So this is just it's messing around with an idea from an old Patrick Honohan paper, that he was arguing that the specific monetary eras led to or associated with different growth rates. So the currency commission one versus the floating. The floating has one of the higher rates marginally, but there's no real difference between the different eras. So I should probably point out, I'm not saying that they caused the monetary regime caused the growth rates. The last bit here is just protectionism, a bit about economic nationalism and trade war. So the first point is this trade war. So this is a nice cartoon. This is kind of UK accidentally pointing the gun at itself. So this is in context of the time, right? So there's gradual implementation of protectionism following the Great Depression. So the UK gradually implements tariffs 1931 onwards. Ireland follows suit. There's a trade war as a result of Ireland defaulting on repayments of these land bonds. So the land bonds that were issued pre-independence under the various agreements that were supposed to be transferred to Westminster. It all goes okay until there's a change of government in 1932. Government campaigns on purposely defaulting. So this is the first and only default in the history of the Free State. This is like the lowest ebb of UK-Irish relations until like recent times. So this trade war has ended with a bilateral trade agreement in 1938. There's an agreement on the outstanding annuities. It's actually really beneficial in Ireland's favour. The context is that the UK doesn't want a hostile neighbour coming into the Second World War. So there's an agreement that rather than paying the 100 million that's outstanding, that it's a 10 million pound settlement. And part of the reason for this from the Free State is that it's viewed as an odious debt. So this is viewed as, you know, basically buying a bailout for landlords that weren't Irish landlords in the past. So why should the Irish people be forced to pay this money? That was the argument of De Valera. In terms of trade, so the trade war, I try to highlight most of the figures have been shown with these kind of vertical lines highlighting the period of economic war, but there's no real like change in trade. So Irish exports continued to be primarily to the UK. So this is just the distribution of exports. There was a slight drop in terms of like the amount of exports. Irish imports from the UK. The figure here is misleading because there's actually a change in classification in 1936. So imports were recorded by country of consignment up to 1936 and afterwards country of origin. So it's kind of the same as what's happening with UK trade at the moment. Once UK left EU, there's a change in classification. So the figures are slightly distorted. But overall, you don't see a major change. And Irish exports are predominantly agricultural. So Ireland is still predominantly agricultural. And not only that, it's mainly live animals. So live animals actually take the brunt of the hit during the economic war because this is where the UK places tariffs on livestock imports. You actually see a lot of smuggling across the Northern Irish border as well as a way to evade that. Irish GDP then, the default gives a slight boost to GDP. So you can see this in the decomposition that after the default and a change to more protectionist administration, it's a one-time fiscal stimulus with kind of a boost in the 1930s. And this is kind of like the implication. So there's kind of import substitution / economic nationalism. It's an attempt to, you know, create what Sinn Féin have been arguing for. And so you see this formation of industry, employment tends to be located near ports. There's a lot of lobbying to where it should be located. The net output tends to be, you know, Dublin. So this is where you create this regional inequality within Ireland. It's effectively mimicking what's going on in the UK in miniature. So instead of London, it's now Dublin is dominant in this sense.
Just another minute.
Okay, I'll finish up then. So FDI, it's mainly British up to this point. The only big one is Ford. And then balance of payments. The thing that stops any kind of major balance payments crises before the 50s is the fact that Ireland has large overseas assets, and it's mainly from a developed financial system. So the banks all have overseas assets, and there's only one major balance of payments crisis, which is in the 50s, which coincides with the rate problem. What are the lessons, or why is it so cautious? So this is kind of the joke in Ireland, is that they just painted the post boxes. They were red, they painted them green. Why didn't they do more? And it really is about trying to create confidence in the new state. They were very cautious. They didn't want to scare kind of business interests away, because business were not supportive of this, you know, so it's trying to get buy-in from business. A lot of institutional continuity. So it's basically maintaining these institutions from the UK. A lot of them are actually bad institutions, and they don't have the ability to change them or the ingenuity to change them. So it's the same problems that the UK has in the 20th century. UK is sick man of Europe. Ireland is tied to the sick man. So lessons for today. just like the big ones for Sinn Féin in Ireland, it's easy to make these big promises in opposition, very hard to implement them in government. So it's the same for Sinn Féin 1920s, the same for Sinn Féin today. And for Scotland, the currency question, Ireland pegged to the sterling for an extended period of time before deciding what was the best course of action. But, you know, public finances determined that sacrifices had to be made, like they couldn't maintain the same level. So that's everything. Okay, I'll stop sharing.
Thank you very much. Well, we've run a bit over time. Is there any quick questions? Anybody in here have a question? Anybody from the audience? Yeah, well, Ronald McDonald has a question here. So, oh, sorry. No. I'll take the ones online first.
Yeah.
Ronald.
Yeah, maybe I could ask you just to maybe elaborate a bit on the point you made in the conclusion there about the relevance of the Irish experience for Scotland. I mean, I would imagine the circumstances are so different in terms of capital mobility in particular, but also, of course, our banks are effectively brass-plated in London now. So they're going to be a drain on the balance of payments through net factor payments. So I think would argue it's a very different scenario, and it's still a fixed exchange rate, of course, which is incompatible, I think, with the size of the current account deficit. But I'd be interested to get your reflections on that, because it's, you know, a very interesting presentation and clearly lots of other parallels, but I think lots of other differences as well.
Yeah, so just on the balance of payments, so the Irish banks always used when they were part of the UK, they always used the London money market. There was no Irish money market. So even after independence, they were always using the money market, and that was, they all effectively, they had kind of subsidiaries in London as well. So like the big banks were headquartered in London before independence. So the National was actually headquartered there. And so when they're basically sending over Irish deposits to London. So that's for the balance of payments. These were kind of foreign reserves, effectively. So that's the only thing that changed overnight. And this is what really supported the kind of Irish balance of payments. And then the Irish Currency Board was like a traditional currency board. It was very conservative. It held a lot more foreign reserves than it needed to. Actually almost double what it needed to in foreign reserves. So it was always very, very cautious. So how exactly it relates to today, like I know like a lot of Scottish banks will be located in London, but a lot of the deposits will come from Scotland as well. Like people in Scotland do save, and where does that money go? That was the same for Ireland. The people in Ireland saved most of the kind of assets of the Irish banks were all in overseas, because they tend to be very conservative in terms of lending within Ireland. They kind of found it very hard to actually find anything profitable to lend to. So this kind of supported the balance of payments. And when there was that crisis, because that's what I thought was interesting when you were talking this morning, you know, when would markets react? When would they expect a crisis? The only crisis came in 1955. And it was when kind of politics tried to, you know, ignore what was like how this had worked was, you know, you follow what Britain does, you follow the master. This is a slave currency. But they tried to go independently. They were happy, they were complacent in how this system worked. And that shock is really what set them off for doing something different, because they realized they couldn't be complacent anymore. They had to be proactive. They had to look to other avenues. So that crisis actually spurred on what will be the future kind of Celtic Tiger reforms.
Okay, so Jonathan, you're taking your hand down. So did you have a question, David?
Well, it was exactly, I think, your last point. What was it that triggered the transition from caution to the transformation into the Celtic Tiger? Was it a response to a crisis, or was it a more general realization that the policy had been too cautious for a long time?
So the traditional narrative sees like entry into Europe. So trade diversification only happens for entry into Europe, right? So they liberalized in the 60s. They have a free trade agreement with the UK, but this is in anticipation of entering into Europe. But in terms of monetary the big shakeup was that 1955 crisis. That is the major macro crisis for 20th century, mid 20th century Ireland. Like after that, they realized they can't be complacent. This led to huge kind of emigration outflows from the country as well, huge unemployment shock. So it had a major effect on the island. And it's part of these kind of back-to-back balance of payments crises. So there's one, like it's after the Second World War, it's dealing with the kind of the legacy of the war. It's dealing with the sterling devaluation. 1949 is another thing that goes on there. Like they're really upset that sterling devalued 1949 without telling them. And so there was calls for like, should we break this link now? After 55, they really start to question it more and more. And you start to see when the Central Bank of Ireland starts to act more like a central bank is from the 60s. So they're taking account of this. Yeah, when the Celtic Tiger really kicks in is obviously going to be later, but the kind of change in the kind of the mindset of administration is from the 50s onwards. So I hope that is
no, thank you.
Well, thank you very much. We've quite badly overrun, but I just want to thank everybody from Adrian and myself, if he's there, but thank everybody for their contributions and the attendees. And for the panelists, we'll be sending emails to try, to get you to send papers in and sending reminders in the coming period, so you can be sure of that. But again, thank you very much to everybody, and hopefully see you all for the launch of the special issue in due course, whenever that will be. Okay, thank you.
Thank you.